What's up, guys? Brendan here. So I had to trim the beard. It was getting a little too itchy and I just couldn't stand it. So I know, weak. Anyway, the markets have continued their recent volatility, and at times like these, I like to think, keep calm and carry on. This phrase was originally coined during World War II by the British government as a motivational poster, intended to raise the morale of the public. I like to apply this slogan to the investment markets and their ability to persist through good times and bad. Given the uncertainty we're living through recently, these are great words of advice. It's hard to ignore the noise and stay invested. As market volatility continues to increase and the media plays on our emotions, it takes extra willpower to stay invested and ride the markets through its ups and downs. So how can you be sure that you have the right portfolio that will be suitable for your goals and investment objectives? We've all heard about the importance of diversification when it comes to investing, but how do you know if your portfolio is properly diversified? So to help you out, I've come up with 9 easy ways to tell if your portfolio is right for you. So let's get into it. So number 1 is that you're so well diversified that you own at least one disappointing investment. This is the only way to tell that you're properly diversified. You could also title this, you're so well diversified that you own at least one favorable investment. Year over year, no one knows which areas or sectors of the market will out or underperform. In 2018, for example, 1-month US Treasury bills were the best performing asset class. In 2019, this flipped, and they were one of the worst. 1-month US Treasury bills are generally considered the risk-free rate of return, or the minimum investment you should expect with taking the least amount of risk as possible. The best way to increase your risk-adjusted return is to properly diversify your portfolio. It's impossible to predict which area of the market will perform best each year, so it's in your best interest to just invest in all of them. Number 2, you can remember the last time you rebalanced your portfolio. Rebalancing is the periodic act of selling and buying different parts of your portfolio that become over or undervalued. This is extremely important for investment performance. The best advice is to pick an investment allocation that is best for your situation, your goals, your time horizon, your risk tolerance, and then you have to stick to it for a long period of time. Periodic rebalancing will force you to sell your winning investments and buy your losing investments. This is the easiest way to take emotions out of investing. It's also the best way to sell high and buy low. Now, there's no guarantee that your winners won't continue to outperform and your losers won't continue to underperform, but history has shown that this trend tends to reverse over time and you'll be better off. Now, number 3, you have no real clue how your investments will perform, but you know how much they cost you. There's no real way to predict how markets will perform over shorter periods of time. The markets have already taken into account all available information and given an appropriate price for each investment. The markets are very efficient at this, and no one can legally control the performance of any given investment, and no one has consistently been able to pick winning stocks over time. Active investment managers, which are managers who try and pick stocks, have time and time again underperformed the overall markets. In any given year, about 90% of active managers will underperform their benchmarks. And of those 10% that were able to outperform, about 90% of those in the following year will underperform. So each year, about 10% of active managers has the chance to outperform their benchmark, regardless of historical performance. Now, I don't like those odds, so rather than using active managers, I just invest in indexes and leave it and forget it. Now, while no one's been able to consistently pick stocks that outperform the markets, there are a few things under your control. Starting with cost. Choose low-cost investments. Historically, investments with higher expense ratios, so they're more expensive to own, have actually underperformed those with lower expense ratios. This is because expense ratios are netted out in overall performance. So these more expensive investments not only have to beat their benchmarks, but they also have to make up for their increased fee. A few of the other items that are under your control when it comes to investing, one we've already mentioned, staying diversified, and the other is staying disciplined. Stay invested, don't try and time the markets. So 4, you don't have any hot stocks to boast about. I've found that some people love to talk about how great of an investor they are, and they'll tell anyone who will listen about their last great stock pick. This can create feelings of FOMO and a longing to pick stocks yourself that will outperform. But what these people conveniently forget to tell you is about all the stocks they picked that didn't outperform. To me, this is a very egocentric idea. People love to pat themselves on the back and tell everyone how smart they are and how great an investor they are, but know that for every winning stock they're telling you about, there's likely several other losing stocks. You can also take satisfaction in the fact that if you are well diversified, then you likely own the investment they're talking about anyway, just maybe in a lower concentration, but you still did participate in the upside. Number 5, for every dollar you've saved, you have an eventual use in mind and you're invested appropriately. You should have specific goals in mind for your money, and it should be invested suitably to help you achieve those goals. For example, if you have money that's intended for a down payment on a home in a year, that should be invested very differently than retirement money that's intended for 30 plus years from now. Number 6, a year from now, you plan to own the same investments. You should have a specific investment plan and you should stick to it. You don't want to be out trying to find the next hot stock. Historically, you have the best performance if you choose an investment strategy and then stick to it. Number 7, you take losses when they're available. This is very relevant to today. Obviously, we hope that none of our investments ever go down, but if you're properly diversified, then it's bound to happen at some point. While this isn't ideal, you can take advantage of it when it happens. You can temporarily sell certain positions in your portfolio that are at a loss, and then you can use those losses to offset gains in your portfolio. Or if you don't have any realized gains, you can use those losses to offset income up to $3,000 a year. You can invest the proceeds from your sale in a similar investment for at least 30 days to offset the wash sale rules, and then you can choose to stick with that investment or go back to your original one. So number 8, you can sleep at night without worrying about the stock market. It's important to choose the right asset allocation for you. Volatility has returned to the markets, and many investors are running for the sidelines. When we're in the midst of a bull market like we've had for the last 10 years, it is easy to convince yourself that you should have a more aggressive allocation, which is a higher percentage in stocks. But you need to choose an allocation that you can stick with in a bear market as well. So using the current market environment as an example, if you had invested $100,000 100% in equity, so very aggressively allocated, then during this downturn, you would have lost about 30% or $30,000. So that $100,000 investment would only be worth $70K today. Could you handle that, or would you want to sell out of the market? If your answer is that you'd want to sell out because you're unsure if the markets will continue to decline, then you are too aggressively allocated, and you should increase your bond exposure and reduce your stock. Although, now is not the time to do that. You need to figure this out before the market correction. At this point, you need to stay disciplined, stay invested, and then once the markets rebound, you can reassess your investment allocation. The most important thing when it comes to investing is to stay disciplined. You cannot react to market movements, or you'll end up selling low and buying high, which is the exact opposite of what you want to do. If you stick to a specific asset allocation and rebalance annually, then you'll tend to sell towards market highs and buy towards market lows. Now, this is because in a given year, if the stock markets decline, then bonds tend to either go up or not decline by as much as the stocks. This increases the bond's relative allocation in your portfolio. So to bring your portfolio back to your target asset allocation, you have to sell bonds and buy stocks. And the reverse is also true. If the stock market goes up, then bonds tend to not go up by as much or stay relatively level. So in this scenario, your asset allocation, your stocks will rise. So you'll sell stocks and buy bonds. So number 9, you don't have cash sitting on the sidelines waiting for the next market correction. We are currently in the middle of the next market correction. And even if you thought the markets were overvalued, I highly doubt that you knew the exact timing and reason for this recent market decline. No one knows when this current correction will end or how the markets will perform in the coming days, weeks, and months, but you shouldn't be trying to time the markets. If you have a proper asset allocation and you rebalance periodically, then you'll naturally take advantage of the market's highs and lows, as I just mentioned. In volatile markets like today, a lot of people like to talk about dollar cost averaging, or DCA. This is where you systematically invest a set amount of money per period, usually monthly. This ensures that you don't invest all of your money at a market high or market low, but somewhere in the middle. Now, Vanguard actually performed a study to determine if it was better to invest all of your money one time initially or to invest a little bit over time through DCA. Now, Vanguard's study found that on average, an immediate lump sum investment has outperformed systematic implementation strategies across global markets. This conclusion is consistent with finance theory, as immediate investment exposes cash to historically upward trending markets for a greater period of time. So basically, the study said that because markets tend to go up over time, in most market scenarios, you're better off investing immediately rather than dollar cost averaging into the market. Now, I understand that dollar cost averaging is emotionally easier. When you invest all of your money, there's always the fear that you're investing at a high or right before a big dip. Now, if you're still earning money and adding to your investments, then you will naturally dollar cost average over time. I personally keep an emergency fund of cash of at least 3 to 6 months worth of expenses and then invest the rest as it comes in. So what did you think of this video and this list? Was there anything I missed out or forgot? Let me know in the comments below. Also, if you like this video, please hit the like button and subscribe and hit the little bell icon so you don't miss any future videos. Invest for the long term and then ignore the markets. Keep calm and carry on.